The bond bull market that lasted 4 decades came to a halt in 2020. The yield on long-dated government bonds has quadrupled. Now what? Facing off on this question are two extremists, both longtime analysts of the yield curve, both stubbornly sticking to views they have long held. One, a bull on bonds, was spectacularly right for 38 years and then just as spectacularly wrong. The other has a track record that is almost a mirror image. The bull is Gary Shilling, a Ph.D. economist whose A Gary Shilling's Insight newsletter is aimed at corporate treasurers and money managers. In 1982 he made the very contrarian argument that inflation was destined to recede, meaning you'd do well to own long-dated Treasury bonds whose coupons were fat in anticipation of high inflation. He's making the same argument today. In the portfolios he manages he's long the long bond and long the US dollar. James Grant, publisher of Grant's Interest Rate Observer, is the bear, sour on both government bonds and the dollars with which they will be redeemed. For a long time, his letter has offered acerbic comments about the Ph.D. standard of monetary management, by which Grant means the Federal Reserve's theories about why it's a good idea to print money with abandon. He thinks gold is a better store of value than a greenback. When Forbes asks Grant, "Did you first become skeptical about fiat currency in grade school?" Deflecting the question, he notes that he recently confessed to his readers that his recommendation to get out of bonds was a bit early. It came in 2004, 16 years before their prices peaked. These polar opposites have a few things in common. They were both, in the 20th century, columnists for Forbes magazine. They both think a recession is likely, albeit for very different reasons. Shilling, because an inverted yield curve and other statistics indicate that. Grant, because a decade of artificially suppressed interest rates has created so much financial mischief. They both have agrarian instincts. Shilling collects honey from 60 beehives near his Springfield, New Jersey, office. Grant presides over 250 acres of cropland, timber and pasture a few hours north of his Manhattan office. Shilling advances several arguments for the proposition that inflation will subside. First is that inflation is not so much a monetary phenomenon as the consequence of excess demand. The U.S. experiences that in times of war or pandemic but is not experiencing it now. Next is that technology depresses costs, albeit after a lag. The American Industrial Revolution started in New England in the 1700s and only after the Civil War became important. Railroads took 50 years before they became important. He expects something good to come from artificial intelligence, even if people expecting an immediate boost to productivity are disappointed. Finally, there's Shilling's belief that the price-depressing effect of globalization is not over.